Thank you for that. Okay, so this is the agenda for the first week, that is 27th to 30th May, right? That is the Monday, Tuesday, Wednesday, and Thursday, first week. So these are the topics that we are going to study. First of all, we'll do some basic calculator settings. This will really help you throughout level 1, level 2, and level 3, right? I would recommend that you keep these settings for all 3 levels. It will save you a lot of time, and it will also increase your accuracy while doing questions. Okay, then we'll get into the first topic of quants, which is interest rate. We will understand the basics of interest rates and what are the different kinds of interest rates. Then we'll understand how interest rate is divided into risk-free rate and different risk premiums. Then we'll understand the holding period return, moving on with arithmetic mean, geometric mean, and harmonic mean, and then money weighted return and time weighted return. I think this is maybe here or here is somewhere we will end our today's class, and then we'll continue from annualized return tomorrow, or maybe from MWR. We'll see how it goes. Okay, so this is today's agenda, but if you look at everything, probably this is what we are going to cover in this week. Let's say if we finish this by Wednesday only, then of course we'll move on with next topic for our Thursday class. Okay, class timings are 7 p.m. to 10 p.m. Monday, Tuesday, Wednesday, Thursday. And every class we will take one break of 15 minutes, which is going to be between 8:30 and 9 p.m. Okay, and after that we'll resume the class and end it by 10 p.m. Right? After I go, teach everything in the lecture, I really encourage that after going back, you read the study material, whichever study material you are following. Okay, you give it a read of all the topics that we have covered in the class. This will help you to understand these topics better, and it will also help you in the next class. Then, if you can solve the in between topic questions. Okay, in between topic questions, whatever questions are there in your study material, try to solve them. If you have any doubt, if you're not able to understand any questions, you can just drop me a WhatsApp for that. And then, of course, when we come tomorrow again for the next class, present your doubts, whatever doubts you have, right? During the flow of the class, you can stop me anytime. No question is lame or no question is too obvious for me, because I know that people are coming from different backgrounds. Something which is easy for a commerce guy might not be that easy for someone who's from engineering or math background, and vice versa. So no question is lame or easy or too obvious. No one will judge you. We are here to learn. So you can stop me anytime to ask any questions that you have, anything you want me to repeat again, not a problem. Right? It is my job that you understand everything that I'm teaching. Okay? Any doubt in that? Cool. One more thing, guys, before we begin, everyone is comfortable here with a mix of English and Hindi. Even if a single student doesn't understand Hindi, then I will make sure that, maximum I do it in English only. Anyone who has a problem with little bit of Hindi, that's okay. Not a big deal. Okay, so I hope mix of Hindi English will work. Okay, cool. Okay, I get it. Cool. And other than that, I also want to know what all subjects you guys have already covered. Can you quickly just tell me? If you have covered a lot of subjects, then you can tell me what you have not covered. Or is it the first chapter? So, eco and equity, that's it? Eco, equity, that's it, right? Okay, perfect. So this is your third subject. Got it. Great. Cool. I wanted to know because there is some overlap. So I'll make sure that, I covered that now. Got it. Let's move on. So first of all, we'll do these calculator settings. Okay. These are some really important settings that we have to do. For that, what I'll do, I'll share a different screen that is from my mobile. And then I'll show you how to do it in my mobile, and then you can do it. All of you have your calculators handy, I hope. All of you pull out your financial calculators and do this setting. I'm going to, now pull up my mobile screen. Just a moment. Okay. So everyone can see my mobile screen right now. Okay, great. Cool. So the first setting that I want you to do is that you set your decimal to 9 decimals. Okay. Now how to do that? You click on second. Okay. Then you click on format. It's in the bottom above the dot sign, right? This particular, this one, right? So you click on format and this is what it should be. Dec equals to 9. If it is some any other number, you just click on 9 and press enter. Okay, so dec equals to 9. This is what should be visible on your screen. Everyone has done this?
Sir, could you repeat it? I'm so sorry.
No problem. So what you have to do is you click on second, the yellow button second. Then you click on format. This is format, right? On top of dot. So click on format. And then you press 9. And then you press enter. Enter is top second button from left below set, right? Click on enter. So dec equals to 9. This is what should be visible on your screen.
Yes, sir.
Okay, everyone is getting this? Dec equals to 9. No, it should not be 0.9. It should be 9. So if it is 0.9, you just click on 9 and press enter. Okay, perfect. Now let's reset everything. Okay. Now, second setting is AOS setting. First, we will do the setting and then we will understand why we did that setting. Okay. So then again, same thing, click on second.
Excuse me, sir.
Yeah.
So can you please tell us that how to reset these settings?
No, I'm not resetting the settings. I'm just coming on the home screen, basically just clicking on CE/C.
Okay, sir. Okay, I got it.
Okay. Perfect. So now we are on the home screen. Basically 0 is visible, right? Now you click on second again and you click on format. Okay. Same first two steps. It should be 9, Saurabh. It should be 9. Always keep it as 9. Decimal places should be 9. I'll explain why is it like that. Okay, so now everyone is saying dec equals to 9. Now you press the down arrow 4 times, right? Down arrow is written below I and S. So you click it 4 times. 1, 2, 3, 4. Right? Some might be seeing AOS, some might be seeing CHN. Okay? It should be AOS. If you are seeing AOS, do nothing. Okay? If you are seeing AOS, do nothing. I will tell it about the students who can see CHN. Okay? So you click on second and then you click on set, right? Above the enter, right? So you click on that button, right? And you click on it until you can see AOS. Okay? So it will be either CHN or AOS. So everyone can see AOS now? Okay, some students are saying no, they cannot see AOS. Okay, so can you unmute yourself and tell me whether is it CHN?
So no, on my screen it's showing EUR 31/12/1990.
Yeah, that is because you have clicked down arrow only 3 times. So you're supposed to click the down arrow 4 times. Okay, so we'll now do it from the beginning. Okay, you click on CE/C. Okay, come on the home screen. Okay.
Yes.
Now click on second.
Yes.
Format.
Okay.
Now you click the down arrow 4 times. So 1, 2, 3, 4.
4. Yes, CHN.
Okay. Now you click on second again.
Okay.
And then click on set, SET set.
Yes, AOS.
Okay, that's it. Everyone can see AOS. Anyone who is seeing CHN, I can again tell you, no problem. It's very, very, very important. Okay, great. Cool. So now everyone has gotten AOS. Perfect. Now you can come back to your home screen. Keep your calculators handy. We'll need it again. So now I'm coming back on my laptop screen. Okay. Great. So now why did we do this? I'll let you know. So see what happens is if your decimal or dec is only, let's say 3, right? And you are doing some fraction calculation and your answer is supposed to be 3.142857 or something like that, right? But if you will have only 3 decimals, what will your calculator show you? 3.143, right? So like it's not a big deal if you have no, if you're dealing only with decimals, but sometimes, when we are doing covariance or variance calculation, right, it will come in later readings. Sometimes you have numbers like this, 000577, right? And as soon as you will enter it in your calculator and your calculator is set to 3 decimals, it will quickly convert it to 001. That's it, right? And in covariance calculation, you have to take a square root a lot of times. So if you take a square root of these two numbers, the answers will be absolutely different, right? So just because of rounding off, you will have a wrong answer. So that's why it is important you keep it to 9. What happens whenever you have set, when you have set it to 9, right? Then it means it will keep it to how many decimals are needed. If the answer is 1.35, it won't give you 1.35000000. It will just give you the 1.35, right? But if the answer is 0.000577, then it will give you that. So 9, that's why we set it at 9, so that it doesn't make unnecessary rounding. Okay? So it will really come in handy during covariance and variance calculation. Not so much in bond calculation, but yeah, covariance and variance calculation, it will be very important. Okay, so that's why, and you will never, feel the harm of putting it at 9. There will be no drawback of putting it at 9 because rounding off you can also do. Right? What is AOS now? See, AOS, it's just mean what we studied in high school, the BODMAS calculation, right? Everyone remembers BODMAS? BODMAS is bracket, right? Division, multiplication, addition, subtraction. So this is a preference that BODMAS rule has set. So if you set it to AOS, your calculator will also, follow this preference. So let's say if you have a numerical, this is especially helpful in expected value calculation. If you're trying to calculate expected value of a portfolio, right? Then your equation might look like 0.4 into 1.9 plus 0.2 into 0.9 plus 0.2 into, let's say, 1, right? So now if you have CHN, what will you have to do? If you write 0.4 into 1.9 plus, and now you're about to write 0.2 into 0.9, right? So it will do this part later on. And first it will take a product and add 0.2 to this, right? So then your answer will go absolutely haywire. Because in CHN, it does not follow BODMAS. It will just follow whatever you're writing first. Okay? So, but if you do it on AOS, it will follow BODMAS. So you will not have to calculate these numbers individually and then this individually and this individually and then add everything, right? That will just take double amount of time, right? So by having AOS setting on your calculator, you can just straight away type on your calculator. This is not CHN, this is AOS. You can straight away type on your calculator 0.4 into 1.9 plus 0.2 into 0.9 plus 0.2 into 1. That's it, and it will give you absolutely correct answer in the end.
Okay, what does AOS and CHN stand for?
So AOS stands for algebraic operating system. So that just means it follows BODMAS. CHN, I'm not that aware of.
Okay.
Okay. No, so if it is set on A, still you can see AOS on your calculator, no problem. You just click on CE/C. That's it. It won't change it back to CHN. It will only change it back to CHN if you click on second and then you click on set. Okay. So now your calculator is set at AOS. You just come back to the home screen. Okay, so always make sure that your calculator is on AOS until your level 3, and even after that, even if you're working in finance, of course you will not need calculator because everything is done on computer these days. But still, just to make sure that you can do these kind of long calculations very quickly and very accurately, right? So that's why we'll always keep it on AOS mode. Okay, I hope both the settings are clear. Now we'll move on. Perfect. So now we are actually beginning with the course, beginning with the actual reading of quantitative methods. First topic in quant is interest rates, right? We all know we are, we keep seeing interest rates all the time, right? There is the RBI ka repo, that's also an interest rate. Then there is US Fed, which is the Central Bank of America, US Fed rate. Right? Then you have a bank account savings interest rate, whichever interest rate you get in your saving. Then there is some FD rate, right? Then there is some rate on the government bonds, right? So these are all sorts of interest rates. But why was these interest rates, developed? What is the logic? Why are these interest rates needed in the market? So broadly, there are three uses of interest rates. Okay, these are the uses of interest rates. First of all, it is used to understand or predict or calculate the required rate of return, right? Sometimes required rate of returns are used to denote some interest rates. Okay, what is a required rate of return? A required rate of return is when investors and savers are willing to invest or save their money, right? So this is some required of rate of return. Let's say the bank FD is giving me 5%, right? Now I'm considering or contemplating investing in a mutual fund, right? I know that there is some risk in the mutual fund, right? When I'm contemplating that to invest in a mutual fund, I will think in this term, okay, now what is my required rate of return? That with zero risk, right? With zero risk, I can get 5%. Then probably my required rate of return in mutual fund is 10% because I'm going to take some risk, right? So I want to be rewarded for that. So this is just, mentally I'm thinking, okay, if I'm getting 10%, then I'm okay to take this risk. So that becomes my required rate of return. This is the rate I require to take this decision, right? And this is the minimum amount. So required rate of return is the minimum amount needed by an investor to willingly invest their money, which compensates them for the risk taken by sacrificing present consumption, right? So let's say if I'm moving forward with this decision of investing in this mutual fund, so I'm giving up investing in the FD first of all, right? I will have to give up investing in the FD. I will also give up some consumption, right? If I'm not investing, I will probably spend it on Amazon or watch a movie or go out with my friends or go on a vacation, right? So I'm giving up that and then investing in the mutual fund. So that's why I will ask that, okay, if I'm getting 10% return, then I'm okay to give up this consumption, give up this FD and invest in the mutual fund. So that becomes my required rate of return. Whether I will get it or not is another ballgame altogether. That is a question of a lot of other factors. But before making the decision, whenever I'm thinking about it, so this 10% will become the required rate of return. Now it could be 14 if it is a very high risky product, right? It could be 20 or it could be like 40 also, right? But it's just that number which I think is appropriate for me to give up other things to invest in that product. So this is the required rate of return. This is the first kind of interest rate. Second is discount rate. So now required rate of return is something which I need. Discount rate is what? Discount rate is something which is used to discount future cash flows, right? So let's say if you have this timeline 0, 1, 2, and then 3, right? There are some cash flows here, right? Now, if I have to calculate the present value of all these cash flows, I will discount all of these cash flows to today, and then I'll take the sum of everything. So the rate at which I will discount them, which is denoted by small r, that is also an interest rate, which is called as the discount rate, right? So this is the interest rate that reflects the relationship between differentially dated cash flows, right? Because present value is dated today and these three cash flows are dated in the future, right? So that's why this discount rate is used to reflect the relationship between differentially dated cash flows, which is why they're also called the discount rates. Discount rates are used to calculate the present value of future cash flow. Okay?
Excuse me, sir.
Yeah.
Sir, can you please explain discount rates with the help of an example so that we can get the practical view of it?
Yeah, so we will do an example in subsequent slides where we will use the discount rate. So it will be more clearer to you then. Okay?
Yeah. Yeah.
It is just basically for time value, right? You must have done the pre-learning of time value of money, right?
Yeah.
So in that, in that, let's say if you are calculating present value, so then you are discounting the cash flow 1 plus divided by 1 plus R
Yes.
plus cash flow 2 divided by 1 plus R ka square, right? So
Yeah.
on and so forth until cash flow N divided by 1 plus R raised to power of N. So this R is the discount rate. Because you are discounting these cash flows to today.
Okay.
Okay?
Yeah.
Yeah. So is someone has asked that required rate of return is subjective, right? Different for each individual. You are right. It is actually subjective, but it is more appropriate to say that it is different for each asset class rather than for each individual. Okay. Of course, it will depend on each individual's risk appetite as well, but it is more different for different asset classes. Right? It will be different for FD, it will be different for a bond, it will be different for equity, it will be different for a commodity, and it will be hell lot of different for a crypto. Right? So asset classes ke hisab se required rate of return changes much more as compared to how it changes with respect to individuals. Yes, it will be different for nature of investor as well. Yes, absolutely, it will be. But again, the variation of required rate of return depends more on the asset class. What kind of asset class we are dealing with. Then coming to the third form of interest rate, which is the opportunity cost. So opportunity cost is, so see, we said that by investing in this mutual fund, we are giving up consumption, right? So in this case, there was no interest rate in consumption, right? We were not earning anything in the consumption. But let's say we are giving up this FD by investing in this mutual fund. So this is something which we are giving up, right? And this was another investment which was going to earn us something. So in that case, this 5%, it becomes our opportunity cost. This is the cost of opportunity foregone. Okay. It is the cost of not choosing a particular option by choosing something else. Right? That is opportunity cost. For example, for perspective, right? Consider choosing between continuing your job or going for higher studies. Right? Let's say you are currently working in a job which pays you 20 lakhs per annum. Right? It pays you 20 lakhs per annum. Now, you have also gotten an offer from some abroad university where the tuition fee is approximately 40 lakhs. Right? So now what is your actual cost? So this is your total. So your total cost or your actual cost is actually your tuition fee, or, let's say this tuition fee involves everything, going there, coming, living, everything. So this is like a college fee. Right? So, but your total cost is not 40 lakh, because now your total cost is 40 lakh. When you go to the college, also you will give up the 20 lakh which you are going to earn in your job, right? So then this 20 lakh is an opportunity cost. So whenever investors are making financial decision, they should take care of the fact of opportunity cost also, right? Whenever they are choosing an investment, what is the opportunity that they are giving up? That also they need to consider, and that is termed as opportunity cost. So your total cost is now 60 lakhs of going for higher studies. Right? So if you are contemplating this, when will you go for this? Let's say if you are expected to get at least 60 lakh or greater than 60 lakh salary after your higher studies, then you can say, okay, even though I'm paying 60 lakhs today, but I will get compensated when I get a job. So, okay, probably I can go. But let's say if the average placement of your college is 30 lakhs, then there's no point, right? So that's what opportunity cost means. It's the cost of giving up something. Yes, that's what I was explaining based on future earnings. That if your future earnings are greater than your tuition fee plus the opportunity cost, then probably the education is worth it. Okay. Any more doubts in these three kinds of interest rates? Okay. Let me know if there's any other doubt. We can come back to it. No problem. Okay. Now, how does it look mathematically? Right now, we'll look at interest rate as we will divide it in two portions. Right. So now, when we are talking about any interest rate, let's say we are saying that a particular mutual fund gave 15% return in last 1 year. Okay. Now, this return is after the expense ratio and all the fees that the mutual fund charge for management. Investor is getting 15% in their hands, right? So then this interest rate, whatever investors are earning, this will be known as the nominal rate, right? This will be known as the nominal rate. Now, this nominal rate can be divided into two portions. One is the real rate, and second is the inflation rate. Right? Now, let's say the inflation is 6%. Then the real rate, approximately, it is not directly, but approximately this will be 15 minus 6 equals to 9%. So if a mutual fund is earning 15% for you, then that means the net real return that you are earning on that is 9% only, because 6% is being eaten up by the inflation. 6% say your money is depreciating every year. So that's why you are earning 9% of real return on your interest rate, right? Now this is for a mutual fund, which is a risky product. But now let's say you're talking about something which is absolutely risk-free, right? So the least risky products which are assumed in any country are the government bonds, because governments are assumed to be least risky, because even if they default, they will just print the money and pay you, right? Of course, this is not that straightforward, but theoretically, governments are considered to be the least risky creditors, right? So government bonds are the least risky products, right? So whatever returns that you are earning on government bonds, for example, are kind of known as the risk-free return. Okay? Yeah, they're also, they are least risky because they have the lowest credit risk. Why is lowest credit? It's not like that every time they are rich. No, because they can just print the money, right? They have the power of money printing. That's why they are considered to have the lowest credit risk. Now, whatever returns you are earning on your government bonds are kind of known as risk-free return, right? But let's say it is not true for a country like Zimbabwe. Their government has a huge amount of risk. So, of course, exceptions are always there, but more or less governments are considered to be less risky, right? So that return, whatever returns you will earn by lending to the government, that is the return on government bond, and that is known as the risk-free return. Now, let's say there is some government of India bond, which is paying you 7% per annum, right? This is like an interest which you will earn by investing in this bond, right? So this particular interest which the investor will get in their hand, right? This is the in-hand interest which they are getting. This will be called as the nominal risk-free rate. Okay? Because it is risk-free and it is, since it is coming in hand of the investors, it is known as the nominal risk-free rate. Right? Now, if you will divide it into two parts, one part is, of course, will be again inflation. And the difference, whatever will be left here, will be called as the real risk-free rate of return. Okay? So if a government bond is paying 7% and inflation is 6%, then your real your real risk-free rate of return is 1%. But this is approximate, okay? This relationship of nominal is equals to real plus inflation. This is an approximate relationship. If you want to, figure out the exact relationship, the formula looks like this: 1 plus nominal rate of return, nominal risk-free rate of return is equals to 1 plus real risk-free rate of return multiplied by 1 plus inflation premium or inflation return or inflation rate. Okay, this is the exact formula. This is an approximate formula. Right now, whatever. So if you basically want to, there might be a question where they might ask you to calculate the real risk-free rate of return. Right, that will simply become 1 plus nominal risk-free rate of return divided by 1 plus inflation premium. Okay, but always keep it in mind, we are only talking about nominal risk-free rate, right? If some risk is incorporated into this, that means now you are considering some other product, then you will have to do some other calculations as well. But this is like a base case scenario, investing in a government bond, right? So that's why it is a nominal risk-free rate. This is not the nominal rate of return. This is not the same as the 15% nominal rate, right? This is not the same as that. Because this has some risks, right? We'll come to that. But now we are studying only the nominal risk-free rate. So there's a question, could they also be called as a market reference rate? Well, not every time. Sometimes if you directly state that my reference rate is risk-free rate, then yes. But sometimes what happens is the benchmark or reference rate, with which you will compare your returns, it is sometimes stated that risk-free rate or the nominal risk-free rate plus minus 2%. Right? Sometimes it is stated like this. So yeah, sometimes it can be directly referenced, sometimes it can be used in a reference, right? We will see a lot of examples for this. Okay. So let's read the theory now. So the real risk-free rate of return is a theoretical rate on a single period loan that contains no explanation of inflation, because nominal ko we are dividing into real and inflation, right? So inflation is now separated from real rate of return, right? So it contains no expectation of inflation and zero probability of default, right? Since we are talking about risk-free rates until now, we haven't gotten into any sort of risk. So that means real risk-free rate की अगर अपन बात कर रहे हैं, so उसमें से inflation is also gone and any sort of risk is also gone. And this risk could be a risk of default. Okay. So when you eliminate both the inflation and zero probability of default, right? So you are eliminating inflation and the probability of a risk or a default. That will give you a real risk-free rate. Now, let's say if they're talking about, okay, include inflation, but remove, risk. So this will be nominal risk-free rate of return, right? Because now you have included inflation ka impact, right? So what the real risk-free rate represents in economic terms, it's just the time preference, right? It's just the time value of money without considering inflation and risk, right? So this is the degree to which current consumption is preferred to equal future consumption, right? This is just a compensation for not using your money for current compensation or for instant gratification and just investing in an inflation-free and risk-free security, right? So it refers to an investor's increase in purchasing power after adjusting for inflation. So now whatever real returns the investor is earning on top of inflation, that is the amount of return which will increase the purchasing power of your money or the investor's money, right? Because if your real rate is zero, that means your nominal rate is just equals to inflation. That just means that your purchasing power is remaining the same only. if you are able to buy 100 rupees ka house today, after 2 years also you can only, you will be able to buy a similar house only, but it's just that might cost 110, right? But that house condition, quality and size will be same only. So because your purchasing power has not increased, because your nominal return is exactly equals to inflation and your real return has been zero. Only when your real return is positive, that's when your purchasing power increases. So the inflation premium refers to the additional return that investors require to compensate then for the expected inflation rate. Right? I want to be compensated for the inflation, which is actually killing the power of my money. Right? Inflation is like termites, right? They eat up your money. Right? So that's why I want to be compensated at least for inflation over a specific period. So this rate is added as inflation. This basically reduces, right? Whatever the inflation rate is, it reduces the purchasing power of the investors, and they should be compensated for the same. Right? Now, the formula is same here. 1 plus nominal risk-free rate is equals to 1 plus real risk-free rate multiplied by 1 plus expected inflation rate. And this can be approximated as nominal is equals to real plus inflation. Okay? So there's a question in the chat that is it same when it comes to FD? No. If you're taking a FD with any bank, there is still some element of risk, right? That my bank might default, right? There are so many cases of where the banks have defaulted on FDs, right? So many NBFCs have defaulted on their FDs, right? In India and in abroad as well. In 2008, Lehman Brothers could not pay off their FDs. So FD mein there is some inherent risk. So FD return is not equals to nominal risk-free rate. Okay? It is only the government bond ka jo bhi return hoga, that is equal to the nominal risk-free rate. Okay? Anything else? Any other doubt?
Sir, can you explain the inflation premium again?
Inflation is just like, basically the inflation rate, right? Whatever inflation is there in the market, I want to be compensated for that. And that compensation is called inflation premium, right? Let's say if in India, if inflation, which is in the market, is 6%, right? Then I would say, okay, if I want to actually earn some real return, which is positive, what does that mean? That my nominal return should be greater than real return plus, if I want to earn some positive return, then that just means that whatever nominal return I'm earning should be greater than inflation, right? So this inflation, which is the minimum return I want to be compensated for, so that my purchasing power does not reduce, is known as inflation premium. And this is equals to inflation only, inflation rate only. Okay?
Okay, thank you.
Okay, no problem. Anything else? Any other doubt? So, sir, could you talk about NHAI, INVIT bonds too? So these are, see, this is something very off topic, right? This could confuse someone else, but these are just like NHAI bonds just mean National Highway Authority of India, right? So that is also a corporate company. That won't be considered risk-free at all. Even though that interest might look very low, but it is not risk-free. It is very, very low risk compared to, like, for example, equity for that matter. But zero risk we can't say. Because that is also a company, right? That might go to some financial difficulties, that might go bankrupt. I hope not, but there is some inherent risk, right? So that means that iska jo bhi bond ka return hoga, that will also be not equals to nominal risk-free rate. Because there is some risk in that as well.
Sir, how is investors' purchasing power increasing due to inflation?
If your real return is positive, only then. If your real return is positive, that means whatever nominal return you are earning, that is greater than inflation, right? And if you take inflation here, that means nominal return minus inflation is greater than zero. So that means real return is greater than zero. So if your real return, whatever real return you are earning, if whatever real return you are making, it is positive, that means your purchasing power is increasing, right? Because let's say there is a product which is priced at 100 rupees today. Okay, this is the timeline. And there's a product which is priced at 100 rupees. After 1 year, and you know the inflation in India is 6%, right? So after 1 year, this product will be priced at 106, right? Now let's say you have 1,000 rupees today in your pocket, right? So how many units can you buy today?
10 units.
10 units, right? So you can buy 10 units today. And now after 1 year, because inflation is 6%, this product will cost 106. Now let's say you invested in a product which gave you 20% return, right? You invested this 1,000 rupees in something which gave you 20% return.
Yes, sir.
Right? So now how much will you have after 1 year? How much money?
1200.
1,200?
Yes.
Right? So your wealth has grown by 20%. So this is your nominal return. And inflation is only 6%. So the price of the products in the market have grown by 6%. So now how many units can you earn? 12. How many units can you buy? 1,200 by 106. Let's quickly calculate this.
11.32.
11.32, right? So 11, round it off to 11. Right? So now you're able to buy more units, right? With that same amount of money to begin with.
Yes, sir.
So that is why this means that the purchasing power of your 1,000 rupees has increased. But it will only happen if you are earning a nominal return which is greater than inflation. Right? Now let's consider another example. You had 1,000 rupees, right? Now you invested in a product which is earning 2% return. Right? So after 1 year, how much money you have? 1,020.
Yes.
So today you were able to buy 10 units. How many can you buy now? 1,020 divided by 106.
9.6.
9.6, right? Consider that you assume that you can buy fractional units. So now you can buy lesser units. Initially, you were buying 10 units, but now you can buy only 9.6 units, right? So since you invested in a product where the nominal return is less than inflation, your purchasing power reduced, right? Why
Yes,
did this
sir.
happen? Because your real return in this case was negative. Your real return that you have earned is minus 4%, right? So if you are
Yes, sir.
investing in a product which is earning equals to inflation, that means your purchasing power will remain the same. Your standard of life or your life quality will remain the same only. If you are earning less than inflation, that means you are getting poorer and poorer day by day. Right? So if you really want to feel rich and get rich, you need to invest in something which earns more than the inflation. Right?
Yes, sir.
Yeah. So do real rate of return has to be higher and then inflation rate to increase purchasing power. See, real rate of return just needs to be positive to increase purchasing power. Right? Nominal return should be greater than inflation to increase purchasing power. Is it clear?
Yes, sir.
Okay. Right? So that's what purchasing power means. Right? Now, let's say this is only just for 1 year. But if you compound it for, let's say, 10 years, then you will actually become very poor because things will become expensive in the market, but your money is not performed that well and it has not earned good amount of interest. Right? So it compounds over time. Anyone else? Any more doubts? Okay. Moving on. Now, so until now, what we have studied, nominal risk-free rate. right? Risk-free, right? There is no risk. Only inflation is there, but no risk as such. And what is the formula? Approximate formula for this? Real risk-free rate plus inflation premium, right? Now what we will do? Now we will start considering, and now the investors are getting real, right? Up tak we were studying theoretical concepts, but now everything is getting real. Now we will start adding some risks to it, right? We will add some default risk, we will add liquidity risk, and we will add some maturity risk, right? And there are other risks as well. For example, market risk, right? Unsystematic risk and all of that, but that will come on in later reading. For this reading, we are only considering 3 risks, which are default, liquidity, and maturity. What does that mean? That we will study. Okay. So actual securities, right? Securities mean assets which we are investing in the market may have one or more types of risk other than on top of inflation, right? And each added risk increases your required rate of return, right? Each kind of risk which is being added into the picture, the investors will keep increasing their required rate of return based on that. That is the logic behind that. If something has only default risk, then probably I will increase my required rate of return by 2%, right? This is just a random example I'm giving. But let's say if something has default and liquidity risk, then I will add 3% to my required rate of return. This now I will need to be compensated 3% more as compared to the nominal risk-free rate, right? Now let's say if something has default, liquidity, and maturity as well, right? All 3 sorts of risk, then probably I will add 6% to my nominal risk-free rate. And now that will become my required rate of return, right? So as and when more and more risks keep coming into the picture, your expectation of returns keep increasing, right? Let's say if there is some asset class जिसमें default risk भी है, liquidity risk भी है, maturity risk भी है, right? And inflation तो है ही, and that is paying just 2% return, right? That means that is a very bad investment, right? Even after all this risk, the return it is paying is very low, right? So that's why you need a higher required rate of return when you have all sorts of risks. What do these risks mean? So the default risk premium is the additional return or yield that investors demand in compensation for the risk of default, right? On a particular investment, right? What is a risk of default? We will come to that. It reflects the perceived likelihood that the issuer just means someone who is sitting on the other side of the table, right? Whoever we are dealing with, they are also known as counterparty, right? This is also known as counterparty, right? So it reflects the perceived likelihood that the issuer of a debt instrument, such as a bond or a loan, may fail to make scheduled interest payments to you. You are a lender, okay? You are a lender, and and you can also call yourself an investor, because who is lending, is the one who is investing, right? So for your perspective, if you are a lender, the other party or the counterparty is known as the issuer, right? If you're talking about a loan. So the default risk is what? Default risk is the perceived likelihood that the issuer defaults or fails to follow their obligation of making the interest payments to you or repay the principal in full, right? So if I am a lender, right? I am lending some money to a borrower. So that means I'm investing this money to this borrower. This borrower will pay me interest payments, and then ultimately after maturity, he will pay me principal also, whatever amount I've paid him, right? So the risk that the borrower fails to pay the interest or the principal or both of these things, that is known as the default risk, right? So for example, anyone who lent money to a very prominent airlines of India, which does not exist today, those kind of lenders were bearing a huge default risk, right? Which actually got played in the market, right? So that was a default risk because the issuer in question, the said company, they did not make the interest payment, plus they haven't even paid their principal, right? So they defaulted on their obligations. So this is the default risk which the lenders of that company were bearing, right? Any doubt in default risk? Any doubt in counterparty? Have you understood what counterparty means, issuer, all these technical terms? Okay, let me know if you want me to cover anything. Yeah.
Sir, a default risk premium will also be added if the borrower fails to make fails to make payment on the maturity date, like as on a particular date.
So see, this calculation is not done after the deal is happened and now maturity is approaching. This is done before only. So if there
Okay.
is an arrangement with someone, there is some default risk. They might default, they might not default, but the risk exists, right?
Okay, got it.
And that default risk reduces as the financial condition of issuer increases, right? If issuer is very rich, he doesn't have any other loan, that means the default risk is low. But the issuer is very poor, the financial condition is weak, and he has a lot of loans outstanding, that means the default risk is high. So you will add a greater number in that case of issuer. Okay?
Okay, sir, got it. Thank you.
No problem. Now, similar to default, now comes the liquidity risk, right? Liquidity risk means lack of liquidity, right? Not the abundance of liquidity, because higher liquidity means lower risk, right? So liquidity means what? Liquidity is just the ability to quickly buy and sell or to quickly carry out the transactions without distorting the market too much, right? So if you are talking about, let's say, stocks, and you are talking about blue chip stocks, right? The big stocks in the market, they are very highly liquid because you can easily buy and sell them without causing any harm to anyone, right? You might make a profit or a loss, but buying and selling it is very easy, right? It is very easy to quickly you just click the buy button, you will execute the order. You click the sell button, you'll sell the order, right? Now, after blue chip, these are large caps. Then comes the small caps, right? These are smaller companies. They have relatively low liquidity. They are not traded in high amount, right? So they have little bit less liquidity than large cap stock. Now, if you go very below the spectrum, one of the least liquid asset classes are real estate, right? They are very, very low liquidity, right? Why? Because you cannot click a button and sell your real estate, right? For a real estate, you need a lawyer, you need a buyer party, and then you need their lawyer, and then you need to sit on the table, do your negotiation, reach on the price, and after that also sometimes the deal falls off, right? So that means low liquidity, where you cannot just click a button and sell your flat, right? So that's why real estate is considered to be lesser liquid as compared to, for example, stocks, right? So if you are comparing both stocks and real estate, then liquidity premium that will be added for real estate will be more. Ultimately, whatever you get, the required rate of return might be more for stocks or might be less, you don't know. But liquidity premium will be that will be added. It will be higher in case of real estate. Okay, so that's what liquidity premium means. Basically, it is the compensation for lack of liquidity. So liquidity premium is the additional return or yield that investors require in compensation for lack of liquidity or ease of trading of a particular investment. It reflects the risk associated with the inability, right? Focus on this word, inability to quickly and easily convert an investment into cash. That means selling without incurring significant transaction cost or price discount, right? So converting your investment into cash or cash into investment very quickly, that means high liquidity, right? So that's what liquidity premium comes in. Now, the last one is the maturity premium. Maturity premium compensates investors for the increased sensitivity of the market value of a debt to change in market interest rates as maturity is extended. Okay, now we'll understand this with the help of an example, right? Let's say there are two companies, X and Y, right? Assume everything else is same. The financial condition of both the companies is same. The market environment is same, government is same, country is same, all the other factors are same. X is asking you for a loan, right? X wants to borrow your money for 1 year, right? Y wants to borrow your money for 30 years, right? In which case will you ask for a higher interest rate from the lender
Why,
from
sir?
the borrower?
Why?
Absolutely, right? Why? Because you don't know what will happen in 30 years, right? So many things could change. Market could go down, up, economy might change, government might change, company might go through a very bad phase, good phase, right? So this is what is known as the maturity risk, right? Maturity risk. 1 year mein situations are little bit much more predictable as compared to 30 years, right? Yeah, in 30 years, even Y might face a cash crunch, right? Y might go bankrupt. So many risks come into picture, right? So this kind of risk is known as maturity risk. And all of you said that you will ask for a higher interest rate from Y, and both are per annum interest rates only. Why? Because all of you intuitively, even though you have not studied this completely, intuitively, all of you, what you are doing, you are adding something which is called as a maturity premium to the required rate of return, right? Because there is some maturity risk. So this is what a maturity risk mean. And when there is a high maturity compared to a low maturity, that's where you add a high maturity premium to the required rate of return, right? So we have studied 3 risks: default risk, liquidity risk, and maturity risk. Now, whatever the risk is, correspondingly, you have a default premium added to the required rate of return, liquidity premium, and maturity premium. Right? So now we can update the formula of nominal rate of interest. Right? So now if you add all these 3 things, so each of this risk factor is associated with the risk premium that we add to the nominal risk-free rate to adjust for greater default risk. So default risk means greater uski premium, liquidity less ki premium, and longer maturity ki premium relative to a very liquid, very short term, and default free rate such as that on T-bills. T-bills is the US government ka borrowing rate.
So
right?
it's treasury bills, right?
So treasury is also a US government only, but usme bhi if you go further higher on the spectrum of safety, that's where you get T-bills. So T-bills,
Okay.
and then comes treasury. Both are very safe investments, but T-bills are the least risky because they have the shortest maturity. Okay. So
Okay,
I
sir.
said that governments are less risky, right? And if you take all the governments in the world, US government is considered to be the least risky, right? So if you take all the securities, all the asset classes in the whole planet of Earth, then the T-bills, this is the rate at which the US government borrows. That is the least risky instrument in the whole wide world, right? Why? Because dollar is the biggest currency. So if they can never default on that because they will just print dollars, right? Yes, that is ironic that with 20 trillions of debt, still they are considered to be the most stable, predictable, and the safest form of investment. Yeah, that is a good point. So yeah, so if you take T-bills, right? If you take T-bills, that is your T-bills. If you consider T-bills, that is your actual nominal risk-free rate, right? Because T-bills are compensating you for inflation. So that is your nominal risk-free rate. Now you add all these premiums, right? Default premium, illiquidity premium, plus your maturity premium, right? If you add everything, this will ultimately give you a nominal rate of return, right? Now risk-free is gone. Now you are talking about nominal rate of interest, right? So if you expand it further, what is the formula for nominal rate of interest? It's the real risk-free rate plus the first premium you are adding. This is the first compensation that you need. At least earn me the inflation. Otherwise, I will get poor. So inflation premium plus the default risk premium plus the liquidity premium, and then ultimately the maturity premium. if you add all these premium in your real risk-free rate, you get the nominal rate of interest, right? Now, can someone spot in this formula, right? Forget everything which I've written. Can someone spot what is the nominal risk-free rate in this formula? Any guesses? These two terms, guys. If you just take these two terms, that is just your nominal risk-free rate, right? Real risk rate plus inflation, right? So another way to write nominal rate of interest is equals to nominal risk-free rate plus your default risk premium plus your liquidity premium or illiquidity premium, you can say it, plus the maturity premium, right? So if you add these three premium in your nominal risk-free rate, you will get this. Okay? It is not RRF minus inflation, it is RRF plus inflation. Any doubt, guys? Okay. So, sir, can you please repeat again what you said in last 3-4 minutes? Okay, so what I'll do, I'll open that screen, whatever we have covered in last 3-4 minutes. You give and we'll break. Now we'll break. We'll take our first break, and then you can use that time to give it a quick read. Right? It is not very complicated, so you can just read it and understand. Okay, so this is the sheet we covered, right? So just quickly you can read it, and so it's 8:49. So let's take a break. We will meet at 9:05. Okay, 9:05 is when the class will resume. Okay, so it's 9:05. Let's begin, guys. Let's resume our classes. So until now, we have studied like very basics of interest rates. I hope things are making sense. What they're trying to make us understand is the whole point of whatever we have studied till now is basically that, whenever if we begin with a base case scenario, which is a nominal risk-free rate, and as and when new sorts of risks are added in the equation, the investors demand a higher return. As the risk are added, they also add some percentage of return as a premium to the required rate. And the way the risks are increasing, the investors' demands also keep increasing. Right? That's the whole point. Now, this is the formula which we have studied, right? This is all the very basics of nominal rate. Now, we are getting into some more mathematics. Okay?
Excuse me, sir.
Yeah.
So can you please tell maturity premium again?
Maturity premium? I didn't hear you properly. Are you asking about maturity premium?
Yes, sir.
Okay, no problem. See, so what we did it through an example. So let's say there are two companies. Okay. You did not see this example, right?
Yes, I didn't see that.
Okay, cool. So let's say there are two companies, X and Y. Okay. Now, assuming everything else is constant and same, the financial condition of both the companies are exactly the same, right? The market environment is same, the government is same, the country is same, and even the industry in which they are operating is same, right? And they are asking you for your money, right? They want to borrow some money from you. You are a lender in this case. X is asking for 1 year of loan, but Y is asking for 30 years loan. So from which company will you charge a higher interest rate?
I think why?
Why, right? So that is the maturity risk. So the higher the maturity of a particular loan, the higher risk is it has, because a lot can change in 30 years. In 1 year, a lot of things are predictable, more or less.
Yes.
Right? Even though there is some risk in 1 year also, but the risk in 30 years is much more higher than 1 year, right? So because
Yes, it's
a lot of
unpredictable.
yeah, there is a lot of uncertainty, a lot of unpredictability. That is the maturity risk. And you said that you will charge a higher interest from Y, right? So
Yes.
what are you doing? You are intuitively adding some maturity premium to the whatever interest that you will demand from Y, right? So because of maturity risk, you add a maturity premium, right? So that's what maturity means. So the longer the maturity, the higher the risk and the higher premium you will demand. Okay?
Okay. So what's this written? ROR plus maturity.
So this is basically the required rate of return. So you will add a maturity premium to the required rate of return because of this maturity risk.
Okay, sir.
Okay? Cool. Anything else? Anyone, any sort of risk which is not clear, anything not clear in the formula? Yeah, one more time, I'll repeat this formula. So your nominal rate of return or nominal rate of interest is this is the first case to start with, the real risk-free rate, plus you add an inflation premium, default risk premium, liquidity premium. So liquidity premium is just the lack of liquidity, right? Not the abundance of liquidity. And then the maturity premium, basically higher maturity. Right? These things you add. And if you take the first two terms, the one plus two, that will give you the nominal risk-free rate of return. Right? So your nominal rate of interest or your nominal rate of return is simply the nominal risk-free rate plus these three premiums: default, liquidity, and maturity. So now moving on, now we'll study the holding period return. Right? What is holding period return or HPR? It is simply the return without the angle of time, right? You are not concerned in what time that you have earned it, just without the angle of time or without the dimension of time. Without the dimension of time, if you are considering some return, that is your holding period return, right? Let's say that you bought a stock today, right? At t equals to 0. You held it for 500 days, right? You bought it at 100, and then after 500 days, you just sold it for 200. right? Or let's say it is, you just sold it for 160 rupees, right? So now what is your holding period return? It is 60%, right? We're not talking about annualized or anything. It's just the holding period return, which is the 60%, right? That's what holding period return means. So holding period returns refers to the total return earned by an investor over the period in which an investment is held, right? That's why holding period. It measures the percentage change in the value of an investment, including any income received, right? So that income might be in the form of dividends or interest, right? And any change in the investment price or value, that is capital gain, right? So if let's say after I bought it at 100, I sold it at 60, and let's say in between I received a 20 rupees dividend also, right? So now my return is 80%, right? Not 60%. How do you calculate it? So what is the simple formula for holding period return? It is the ending value, right? Whatever is the ending value of your investment minus the beginning value plus any income that you received, right? So EV minus BV plus I divided by BV, divided by your starting value, right? So for our case, our ending value is 160 minus the beginning value is 100 plus the income that we received was 20, everything divided by 100. So this is what? 60 plus 20, 80. So 80 by 100. That means this is 80%. So our holding period return is 80%.
So why can't we just simplify it EV minus BV as ROI?
You'll come to know that because in the further questions that we are going to do, the money weighted return and time weighted return, if you just say ROI, it will become very confusing. So
Got
for
it, sir.
CFA curriculum, EV minus BV plus I divided by BV is the easiest way to remember it. Okay.
Got it, sir.
Okay. So a single period holding period return is EV minus BV plus I divided by BV. Now, if you're talking about multiple period holding period returns, right? Right. What is the holding period return for 4 years? Then you do 1 plus R1 into 1 plus R2 into 1 plus R3 into 1 plus R4. Let's say they're talking about 4 periods, right? So you add 1 and then you take a product of everything and then you just subtract 1, right? Again, the angle of time is still not there. It is just a multi-period holding period return, right? And this is for 4 periods. And this R1, R2, R3, R4 is just holding period return for each period, right? This is HPR1, HPR2. Similarly, this is R4 is HPR4, right? So this is how you calculate multi-period holding period return. We will come back to holding period return. We will solve at least 2 to 3 questions based on holding period return. So it will get more clear. Don't worry. Now, moving on. Coming to arithmetic mean and geometric mean. Okay. Arithmetic mean is simply the average, which you have also studied in your high school mathematics, right? Simply the average of returns, right? Simple average of a series of periodic returns, right? So let's say these are your periodic returns, basically return of year 1, year 2, year 3, year 4, everything divided by n, that is the total number of periods. This could be year or months or days or anything. It's if you just take a simple average and you divide it by n, that is your arithmetic mean return. This is not that great, right? This is not ideal for finance world. If you're just talking about returns, it is ideal for, let's say, the number of, commercial stocks that you have or something like that. Some other average, it might be ideal. But for financial world, it is not that ideal. That's where the that's where the geometric mean return comes in. Geometric mean returns basically takes care of your compounding, right? If you want to understand compounding and how a single dollar is growing at a compound rate, that's where geometric mean return comes into picture, right? And this is annualized. Now this is annualized. So the formula looks like 1 plus R1 into 1 plus R2 into 1 plus R3, so on and so forth until 1 plus R1. So you take a product of everything and then you take the nth root, right? You take the nth root of that product minus 1, right? That is your geometric mean return, right? We'll do an example, but just understand this is a simple average. This is a geometric average, right? And this is more relevant in the investment world. Let's solve this question now. Pull out your calculators. Okay, and now we'll try to solve the question. So for the last 5 years, so N is 5. Straight away write that. Here for the last 5 years, the returns for HDFC Bank stock have been these. Okay. Calculate the arithmetic and the geometric mean return over the 5-year period. Okay. Now let's calculate first the arithmetic mean return, a simple average. So you just add everything and then you divide it by 5. So minus 9.34 plus 23.45 plus 8.92 plus 5.8 minus 28, right? Then you divide everything by 5. So since you are adding everything in percentages, you don't have to convert it into decimal yet because you are just adding all the percentages, right? You can, but it's not necessary. So quickly shoot your answers in the chat box. I'll also calculate.
Minus 28 negative.
Sorry, plus only, plus only. Yeah. What's the answer? Yeah, I'm also getting 11.366. Someone said 5. Can you do what? I think you did minus 28. That was my bad. Sorry about that. So it's plus 28 only. Okay. Hope everyone is getting 11.366. Great. Perfect. Good to see. Yeah. Now let's calculate geometric mean return, right? So the formula will be some number and the fifth root of that number, right? And then 1 plus R1 into 1 plus R2 into 1 plus R3 like that. So 1 minus 0.0. Now you have to convert in decimal because you have to subtract it from 1. So 1 minus 0.0934 multiplied by 1 plus 0.2345 multiplied by 1 plus 0.0892 multiplied by 1 plus 0.058 multiplied by 1 plus 0.28. Right? You take the fifth root of this sum and then you subtract 1. That will be your answer. Right? So now let's write. You can use the bracket function on your calculator also. But I am more comfortable by writing individual terms. So I'll do that. So this is 0.9066 multiplied by 1.2345 multiplied by 1.0892 multiplied by 1.058 multiplied by 1.28, right? Only one negative. Yeah. And then instead of writing square root fifth square root again and again, you can do raised to the power of 1 by 5. That is the fifth root, not the square root, fifth root. Right now, give me the final answer. So this is 1.10546 minus 1. So I think the answer I am getting is 10.546%. Hope everyone is getting the same. 11.26. So how do you take fifth root on BA? You just, so you take this, calculate this product, right? Okay, I'll write that also, but let's first check. Let me check my calculations. I'm getting a different answer. So this product, if you just write this product, it is coming out to be 1.6508. Right? Now, this raised to the power of 1 by 5 minus 1. So what you do is you enter in your calculator 1.6508, then you click y power x. Okay, you tap y power x, and then you have to do 1 by 5. So 1 by 5 is 0.2. So then you enter 0.2, and that's it, is equals to. So this 1.605, then you click y power x, then you enter 0.2, right? This will give you 1.10546, right? Now minus 1. So the final answer I am getting is same only, about the 10.546%. Anyone getting a different answer? I can see 11.26 in the chat box. I don't think my answer is that. Is everyone getting 1.6508? Yeah. Srilekha, can you do the calculations again? And let me know whether you're arriving on the right answer or not. So, okay, some students are asking me to show it on the calculator. So cool, I'll do that. Let me switch to my mobile screen. Just give me a moment.
Recording in progress.
Okay, now I'll show it on my mobile, the working. Okay, wait, there's some ad. Just hold on, guys. There's this annoying ad here. It's not going away. Okay, so everyone is now seeing my calculator. Cool. So I hope you were able to reach on 1.6508, right? Now you just want to understand how to take power, fifth root, right? So you start with 1.6508, right? Then you tap y power x, right? This one below tan, right? So click on that. After that, see 1 by 5 is a very simple fraction, so you can directly do 0.2. But let's say the fraction is a little bit bigger fraction, right? So in that case, you can do a bracket. So after clicking on y power x, you open the bracket, which is below sign, right? This one. So you tap that, and then you do 1 divided by 5, and then you close the bracket. So that gives you 0.2. And now you click on equals to. Right? So you should get this number, 1.1054449, something like that. Is it clear? And now you simply do minus 1. That's it. So 10.55%. Okay, I'll repeat. No problem. So I'm beginning with 1.6508 because that was the product. That was the product of all those things, right? This you should be this you should be able to do because it's very simple calculations, right? So 1.6508. After that, now you have to take the fifth root of this number, right? So click on y power x. Okay, this which is written below tan. Click on y power x. Right? Now you have to do this raised to the power of 1 by 5 to take the fifth root. Right? That is basic middle school mathematics, right? So 1.6508 raised to the power of 1 by 5. Now you, after clicking on y power x, open the bracket, right? This below sign, open the bracket, right? Then do 1, then click on divide wala sign, divided by 5, right? Then close the bracket, which is below cos, close the bracket. So this is the value of the fraction, which is in the power. And you have already clicked on y power x. So now it will give you the final answer. If you click on equals to. So are you able to reach here now? Basit Arif, are you able to get it now? Have you reached on this? Perfect. That's it. After reaching on this, you just do -1 because that is in the formula. So yeah, this is your answer, 10.55%. Okay. So let's move on to the notes now. Cool. So our final answer now becomes 10.55%. Okay. So arithmetic mean came out to be 11.366. Geometric came out to be 10.546. Okay.
So this would be 5-year CAGR, right?
Yes. Yes, it is the 5-year CAGR. Basically, it is the annual return, annual compounding return. So CAGR, basically compounded annual growth rate. This is the absolute CAGR. Why sub 1? I didn't get that. Sub 1 is what? What is the logic? So what do you mean by sub 1? I didn't get that. Acha, subtract 1.
Yeah, -1.
Yeah. So see, this number is getting is 1.1054, right? You cannot deduce any percentage from this, right? And since you are adding 1, right? Let's go back to the formula. If you are adding 1 to all the returns, right? You are adding 1 here, right? So this will come in form of 1 point something or maybe 0.9 or something like that, right? So then ultimately after taking root, you will have to reduce 1 from it to get the exact percentage. Because you're adding 1 in R1, R2, R3. Right? And this is basically just to, so you added 1 because you cannot take the power directly. So you added 1, took the power, and then after bringing it back to return, you subtract 1. Because 1.10544, how do you convert that into a percentage, right? You converted it to percentage after subtracting 1 only, right? Because percentages is in decimal. And percentages is less than 1. So consider 1 as 100%. Right? So now your answer should be in percentages because we are calculating some return. That's why we are subtracting 1.
Okay.
So what if we just take, like, for example, R1, R2, R3, we don't add 1 and we just like do the root of that. So will we get like the same answer or will we get like a different answer?
No, absolutely different answer. And that would
Okay.
not make sense. See, okay, I'll go in one more level of depth here. What this 1 plus R1 means. Okay. So let's assume that you invested. So this is your timeline. Okay. 0, 1, 2, 3, 4, and then 5. Right. Let's assume you invested $1 here. Right. And R1 is the return in first year, R2, R3, R4, R5. Right. So now this $1 will grow by R1, right? So what will be the value of your investment here after 1 year? It will be $1 into 1 plus R1. 1 plus R1, right? Can you agree to this? That this will be the value of the investment if you consider compounding, this will be the value of your investment after 1 year, 1 into 1 plus R1. Yes, no? Can you all agree to this?
Yes, sir. Yeah.
Now, in second year, it will grow by R2. So now this is your beginning principal, right? Because in compounding, your whatever amount that you are getting ultimately, your amount becomes the principal for next year. So now this amount will grow by R2 for second year. So now what is your value of your investment after year 2? First you take your principal, which is 1 into 1 plus R1. So you simply write 1 plus R1. And now this will grow by what?
1 plus
1
R2.
plus R2. Right? So similarly, when you reach the end of your horizon, your $1 will become 1 plus R1 into 1 plus R2 into 1 plus R3, right? Into 1 plus R4 into 1 plus R5. Right? Now, this is the ultimate principle that you have. Now, if you take the fifth root, that will basically, if you take the fifth root or nth root, whatever root, that will give you kind of your average principal 1 plus your CAGR, right? Whatever annual return that you have earned, right? That, and then if you subtract -1 from that, that's when you will get an interest rate, because this is just some investment value, right? So you're subtracting 1 because you are subtracting your beginning principal, right? Which is roughly 100%, right? So to make it in percentage terms, you subtract it, which gives you your geometric mean return. Right? This is what, this is what all those, whenever a mutual fund or any fund for that matter, a portfolio, whenever they're advertising, right, that this fund made a 12% CAGR, right? You must have heard this term somewhere, 15% CAGR, right? They're talking about geometric mean return. Okay?
Normally, geometric mean return is always lower than arithmetic mean return.
We're coming to that. We're going to discuss that part.
Okay.
Okay. So any doubt in the calculation? Okay. So now coming to your question, which is greater, which is lower, right? So we'll read out some points and then we'll understand the logic behind them. See, always remember, geometric mean return is always less than or equals to arithmetic mean return. Okay, this is the rule that it will follow. This is because of the mathematics, right? Here we are adding, here we are multiplying some decimals, right? So if you multiply decimals, it becomes more smaller, right? So that's why GMR will always be less than or equals to AMR, right? If the observations, now whenever I say observation, set of observation, data set, I'm talking about something like this, right? Some different values, right? This kind of, whenever I'm saying observations, right? Data set, always think about, or XI for that matter, it can also be called as XI. Always think about a set of different returns of data. Okay? Just a group of data. Okay? Always remember this. So now whenever the observations are different with each other, right? Let's say, for example, you have this set of data, 7, 8, 9, 10, 11, right? This is some set of data, right? Whenever there are different entries in a data set, always it's a thumb rule, it is guaranteed that your geometric return will be less than your arithmetic mean return, or geometric mean will be less than the arithmetic mean. Only and only if all the observations are equal. Let's say if you had 8, 8, 8, 8, 8, 8, only then your geometric mean will equal the arithmetic mean, and that will equal the equal observations only. Okay? Only when all the observations are same, geometric mean and arithmetic mean are same. Otherwise, geometric mean is always less than the arithmetic mean. Okay? And now this is the first point. Second point. So we know that if the data is different, right? Some different entries in a data set, then geometric mean will always be less than arithmetic mean. Okay? But the magnitude of this difference, right? How much lower geometric mean will be as compared to the arithmetic mean, this magnitude or this difference increases as the dispersion of the observations increase. Right? What is dispersion of the observations? That means if the observations are very spread apart with each other, very spread apart, in that case, the difference between geometric mean and arithmetic mean will also be very large. Right? To understand it with the help of an example. Yes, exactly. It is because of the outliers. So let's understand it with the help of an example. Let's say I have one data set to wait. Let's say I have a data set 2, 4, 6, 8. Okay. A simple data set 2, 4, 6, 8. What is the arithmetic mean return? What is the arithmetic mean basically for this? Five, right? 6 plus 6, 12 plus 8, 20. 20 divided by 4. That is 5. Right? So somewhere here, arithmetic means lies somewhere between 4 and 6. Right? Now there will be some geometric mean. We'll not calculate. But we definitely know that geometric mean will be little bit less than arithmetic mean. Now consider another data set. 2, 4. Okay? 2, 4. Then 1,000. And then 10 lakhs. Okay. This is another data set. There will be some arithmetic mean. There will be some geometric mean. Right. But now what is data is very spread apart, right? There is an extreme outliers, right? Outlier is some extreme values with respect to the normal average. Extreme value with respect to the arithmetic average or arithmetic mean. Those are known as outliers. Right. Now, because of this outlier, arithmetic mean will be very, very high. Right, as compared to this case. And the data is very spread apart as well, right? In this particular case, the GM will be very, 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 very less than the arithmetic mean. Right? So this difference between GM and AM increases as the dispersion of observation increases. If the observations are very close to each other, GM will only be slightly lower than AM. But if the observation is very high, you don't even have to calculate, guys. You don't even have to calculate. We just want to understand the point that if the arithmetic mean, if the data is very spread apart, there are large outliers in the observation, then the GM will be very low than AM. So basically the difference between AM and GM will be very high when observations are very spread apart. That is the point number 2. Then if all observations are exactly equal, AM will be equal to GM. We have already seen that. And this will be equal to whatever the observations are. 4th point. The arithmetic mean return is higher due to the impact of outliers. Right? So this huge difference is because arithmetic का formula क्या होता है? Observation 1 plus observation 2 plus observation 3 plus observation 4 divided by 4, right? So यहाँ पे तो ये 2 plus 4, 6 plus 1,000, basically this will be 1,000, 1,006, right? But then 10 lakhs. So because of this 10 lakh, arithmetic mean will be very, very high. It will become very high. But since there is multiplication in geometric mean and then you are taking square root also, the effect of this outlier is not that much. The effect of this outlier is not that huge in geometric mean. That's why the difference of arithmetic mean and geometric mean is much more higher when the data is very dispersed around the mean. Right? So because of outlier, so what does that mean? Now, what is the reverse point for that? So if there is a huge amount of outlier in the data, then arithmetic mean is not a good way to understand the data. Probably go for geometric mean, because outliers distort arithmetic mean. Right? So the geometric mean return provides a more stable representation of the overall investment performance considering the compound effects of return. right? So in the investment world also, there are outliers, right? If you consider, for example, Indian stock market, 2016, 2017, 2018, and you are just considering March ka returns, 2019, 2020, right? So यहाँ पे सीधा जैसे, like for example, this is plus 14% का return Sensex का, maybe plus 10%, maybe 0%. In 2019, maybe plus 2%, but then suddenly 2020 March COVID hit minus 40%, right? So this iska agar average loge, it will come around somewhere around 8%. Exactly kuch bhi ho, but it will come somewhere around 8%, right? But then this is a huge outlier, right? COVID ka crash. So if you'll just take arithmetic mean, it will not make much sense because that will be a distorted number because of this outlier of minus 40%. So that's why geometric mean return is a better way when there are outliers present. And in the investment worlds, it is filled with outliers everywhere. That's why another point in the favor of geometric mean, that it is a better understanding, it represents a better average of the compounding as compared to arithmetic mean, right? Now there's third category of the mean, which is known as a harmonic mean, right? Till now we were considering HDFC Bank stock car returns, right? So if you're considering returns, geometric mean is better, right? But let's say now you're not talking about returns. Now you're talking about quantity of something, right? Absolute quantity of something. Let's say you are talking about quantity of shares, right? And you purchase, let's say you purchase share of Axis Bank, right? You're purchasing some shares of Axis Bank, right? You purchase 100 shares at 20 rupees. Then you purchase 200 shares at, if it went down, it came down to 15. So you purchase 200 shares, and then it came down to 10. So you purchase 1,000 shares, right? So when you are doing these kind of calculation, cost averaging, or, you might be purchasing it when it is going up. Is case mein harmonic mean is a better example. It will give you your average cost of purchase, right? It will give you your average cost of purchase. That's where harmonic mean comes into picture. So a harmonic mean is used for certain computations, such as the average cost of shares purchased over time, right? What is the formula for harmonic mean? It is n. Arithmetic mean mein n was in the denominator. Now n comes in the numerator. N divided by 1 by x1 plus 1 by x2 plus so on and so forth until 1 by xn. Right? So you do reciprocal. Okay, you do reciprocal. That will give you the harmonic mean. Right? So harmonic mean return is influenced by outlier. But then again, this will also be influenced by outlier, but not as significantly as the arithmetic mean, because it is considering reciprocal of the returns, and then reciprocal is also in the denominator. So it kinds of reduces the distorting impact of outliers, right? So arithmetic return is actually not of great use because it is usually impacted by outlier. Geometric, if you're talking about percentage return, geometric mean is a better way to deal. But if you're talking about average cost of share purchased, then harmonic mean is a better way. It also deals with outliers. Okay, we'll see an example for harmonic mean. Okay, now. Okay, so let's see. An investor purchases $1,000 worth of Apple share each month. $1,000 worth of Apple share each month. And over the last 3 months, the prices paid per share. Now, these are prices paid per share. These are your X1, X2, X3. So he paid $80 per share, then paid $90, then paid $100. What is the average cost per share? So whenever you see average cost per share, that means you have to calculate harmonic mean return, right? So now what is your harmonic mean return? N is 3. So 3 divided by 1 by 80 plus 1 by 90 plus 1 by 100, right? Let's calculate. So calculate the denominator first. That's now your AOS setting will help you. So you start with 1 divided by 80 plus 1 divided by 90 plus 1 divided by 100. So this will give you 3 divided by 0.0336. Now you have 0.0336 on your calculator. You divide it by 3. Okay, that divided by 3, and then you simply click on 1 by x. Okay, if you click on 1 by x, that just reciprocates whatever number you are displaying. So that gives you your final answer, which is 89.256. I hope everyone is getting this.
Sir, can you repeat?
Yeah. So calculate the denominator. So are you getting 0.0336 in your denominator?
Yes, sir.
Okay. So now 0.0336 in your calculator. Now you click on divide and then you click on 3. Okay. So this will give you 0.0336 by 3, but you need ulta. You need 3 by 0.336. So after that, you just select or click on 1 by x. Right? This just reciprocates everything. So that will give you 89.256.
No, sir, it's coming like 22.31.
You're doing some mistake then. So you have 0.0336, right? Now you click on divide and you click on 3. What are you getting? 0.0122, right? You're getting this, na? 0.0112.
Yes, sir.
Now you click on 1 by x. That is your final answer.
Yes, sir, I got it. 89.256.
Yeah. Yeah. Some students are getting similar but wrong answer. 8.9285. So what is the mistake? So is everyone getting this 0.0336? Till here, have you reached? Whoever is getting answer which is not matching with 89.256, have you reached at this point? Then you just, after reaching at 0.0336, you click divide, and then you click on 3, and then you click on equals to. Right? Now you should be getting 0.0112. Are you with me? Yes, no? 0.0112 pe have you reached? Perfect. Now you just click on 1 by x. That is your final answer. 1 by x basically reciprocates everything. So if you have a long calculation in your denominator, this is a good way to do it. Right? You calculate the denominator, you divide it by the numerator, and then you simply click on 1 by x. Right? It will simply reciprocate whatever you get. $89.285 is also fine because I have rounded off here 0.0336. So if you are not rounding off, 89.285 you will get. That is also acceptable, not a problem. 89.285 is acceptable. It is not a wrong answer. Okay. So that's how you calculate your now $89.256. That is the average price of share that they have purchased. Right? Sir, here the quantity is same for 3 months. What else if quantity is not same? Quantity is not same. Quantity is not same. The amount of money is investing is same. $1,000 is investing. Okay, so to answer your question, we'll do some calculations. Okay. So see, whenever they will ask you calculate average cost per share, or average price per share, that means you have to use the harmonic mean ka formula. Right? Why is harmonic mean average cost per share? Right? The CFA curriculum is claiming that harmonic mean equals to average cost per share. Right? Let's verify this claim now. So it is not purchasing same quantity. They are investing the same money every month. Right? So let's verify. What will happen in first month? He's investing $1,000, right? $1,000. So what is the number of shares that he will get? Number of shares that he will get in first month. He's investing $1,000 at $80. Right? So what is the number of shares he's getting? 1,000 divided by 80. So 12.5 shares he will get. Okay. Now let's say he has moved on to month 2 and the share price has increased to 90. So now number of shares, now he's investing the same amount again. $1,000 he's only investing, but now he's investing at 90. So now what is the number of shares he will get? 11.11. Okay. Similarly, now month 3, now the share price have gone up to 100. So now what is the number of shares you'll get? 10. Perfect. So now we want to calculate the average cost per share, right? You want to verify this claim. You want to verify this claim, right? Whether this formula is, whether the CFA curriculum is right or not, right? So let's verify this claim. So how will you now you have this data, right? Now, how will you calculate your average price, right? What is the total amount of money that you are invested? $3,000, right? So if you want to calculate your average cost per share, that will be equals to what? Your total cost, right? Your total cost divided by the total number of shares that you hold, right? So this will be what? 3,000 divided by the total of all these three. So 12.5 plus 11.11. Let's do the total. 12.5 plus 11.11 plus 10. So this comes out to be 23.61, right? Roughly. So now let's calculate this.
So 33.61, not 20.
Sorry. Yeah, 33.61. Sorry. Yeah, 33.61, right? So now let's calculate this. What is the answer you're getting?
89.259.
Absolutely. So now can you see the beauty? That's why they say that harmonic mean helps you calculate the average cost. This is a long procedure. So whenever you are getting a question for average cost, don't do all of this. You can simply do this and calculate the average cost per share.
Sir, I have a question out here.
Yeah. Yeah.
Since the investments were equal over the period of 3 months, but supposing if the investments were not equal, every time a purchase was made and the prices were different, then how would you calculate the average cost?
Then you cannot do harmonic mean. You will have to do like this only, the longer way.
Okay.
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 Then you'll have to go longer way, but that is out of the scope of the syllabus.
Okay.
Harmonic means only when the amount is same. Okay.
Yeah.
Perfect. So now let's summarize everything, right? How to deal with outliers. So let's say you have a data set, right? Now, if you want to include all value and yes, this is similar to SIPs, that investing $1,000 every month, it is similar to SIP, yes. So now if you are not dealing with any outliers and you just want to understand the average, then you will get the arithmetic mean, right? If you want to understand the compound effect, then you will calculate the geometric mean. And let's say you want to deal with outliers, the data set contains outlier, but you don't want to, distort your answer because of outlier. You want to deal with outliers. That's where you will get harmonic mean. And the other types of mean which will help you deal with outliers is simply trimmed mean or Vincerized mean. Now, there is a very small mention of trimmed mean and Vincerized mean. So I'll quickly explain it, but it is not too important. So don't lose hope if you're not able to understand it. There's just a single sentence for this, right? And then we'll end our class. Tomorrow we'll begin by money weighted return. Okay. So what is trimmed mean and Vincerized mean? This is just a method to deal with outliers, right? Now let's say, now first we'll understand trimmed mean. Okay. Trimmed mean. Now, let's say you have a data set. Let's say you have a data set which has extreme outliers, right? Extreme outliers on both the sides. So trimmed mean may, what they will do, let's say they tell you that I want a 90% trimmed mean. So what you will do, you will take the bottom 10% and then you take the top 10% of the data and then just cut it off, right? And whatever new data you have, you calculate the arithmetic mean for that data. So that now you have dealt with your outliers. So that now you will understand the average of the crux, which is in the middle, right? That's how trimmed mean is calculated. You basically trim on both sides, right? Second is Vincerized mean. Right? So if you have to deal with Vincerized mean, and let's say they're talking about a 90, wait. Now they are talking about 95% Vincerized mean. Right? How do you deal with it? Let's say you have a data set, right? Now you start with 0, and then you go up to the point which contains the first 5% of the data, right? And then you move again in the forward, and then you reach the point, that particular value, right? Xi, the particular value which has, after which lies the top 5% of data, right? Then now what you do, you take this value and then you replace it with something which contains some value in the middle. You replace this value with some value which is not an outlier. Similarly, you replace this value which is not an outlier, and then now you will have a new data set. Simply calculate the arithmetic mean for that data set. That will give you Vincerized mean. Okay. Now see, it is very unlikely that you will find a question on this. It's a very small topic. It is, but just what the appropriate question that you might find on this is, which is a good way to deal with outliers, and the option might contain arithmetic mean, right, geometric mean, and Vincerized mean. So this is the best way to deal with outliers, or harmonic or trimmed. So harmonic, trimmed, and Vincerized. Even geometric deals with outliers, but the most appropriate ways to deal with is this. So this is the order of dealing with outliers. Okay.
So I'm finding it difficult
Yeah,
to find the difference between trimmed mean and Vincerized mean.
So trimmed mean, you are absolutely cutting the bottommost 10% and the top 10%. You are not considering them only. Vincerized, you are not cutting. You are marking the points. You are looking at, okay, so this is we will understand measures of location. But so let's say this, if you understand percentiles, right? Percentile. Right. So we are thinking about the fifth percentile, whatever the value of the observation is here. And then we are taking the 95th percentile, right? And then we are, whatever values we have at these two ends, we are just replacing it with the values which are little bit closer to the average, overall average. Right?
Okay, sir. Okay, fine.
That is Vincerized means.
So that's kind of like a data deviation dispersion?
Not exactly. It is just a way to deal with your outliers, because every data has outliers, right? But you don't want that your averages get distorted because of some few outliers. You are concerned about the data which lies in the middle. So that's why you do that.
The major chunk of data.
Exactly.
Okay,
Exactly.
got it.
Okay. So I think this is a good point to now end the class, right? I will share the PDF because MWR, TWR are very important topics and have a lot of calculations. So that's why we'll start afresh tomorrow. I will share the PDF by tonight, right? And go through the PDF, read whatever we have studied. And we have covered up very basic stuff today. Tomorrow we'll get into more complicated stuff. There's a question, same number of both ends? No, not the same number. Only the 5th percentile and 95th percentile. I'll cover it again tomorrow, don't worry. Will trim and Vincerized come as solving sum? I don't get this. We'll cover it again, okay? I have to end the class today. We'll start from here only tomorrow. You put you can put your questions tomorrow. Don't worry. So after the end of the class, all of you will get a feedback. I really encourage that you be as honest as possible in the feedback. I will never come to know who is writing what, but at least I will improve. So please do fill the feedback, positive, negative, constructive criticism. I will take care of the fact. Okay, sir, can we please slow down the speed of learning? Okay, we'll do that. No problem. Right? Please fill the feedback form. Okay. Thank you so much. See you tomorrow again at 7 p.m. I really loved the beginning. It was a very powerful way to begin the sessions and really enjoyed it. Enjoyed it much more than my other classes. So yeah, I will share the
Likewise.
yeah,
Thank
no
you.
problem. Thank you so much. Thank you. See you tomorrow. I
Thank
will share
you.
the
Thank
PDF.
you.
I will share the PDF within 1.5 hours. Okay. See you tomorrow. Thank you. Bye.